$16 billion.
It's a number that actually makes you physically wince, doesn't it?
It does. It really does. I mean, usually when we toss around numbers with a B on this show,
Yeah.
we're talking about, I don't know, a government defense budget.
Or maybe the GDP of a small European nation.
Yeah, exactly. It's nation state money. But in this case, it's not a GDP. It's not a bank bailout. That $16 billion is the amount of money Ford Motor Company has, well, effectively lost on its electric vehicle business since 2022.
Gone. Just poof. And today, we're going to talk about where it went.
And maybe more importantly, for anyone listening who has a stake in this, we're going to figure out why the year 2029 has suddenly become this critical date on the calendar for one of America's most iconic companies.
Absolutely.
Welcome back to the Deep Dive. It is February 19th, 2026. And if you're looking at the auto landscape right now, it is, well, let's just call it messy.
Messy is a very polite way of putting it. I'd go with turbulent. Fair enough. We're working off a really fresh analysis that just dropped yesterday from Daniel Miller over at The Motley Fool. It has all the Q4 2025 numbers, the forecasts, and honestly, it reads less like a financial report and more like a tragedy about timing.
It really is a story about the brutal reality of capital allocation, and it starts with a concept that Miller points out right at the top, which I think, it frames this whole discussion perfectly.
And what's that?
The idea that a massive legacy company can be completely right and catastrophically wrong at the exact same time.
That sounds like a paradox. How does that even work?
Well, think about the big picture. Ford wasn't crazy. They looked at the future, they saw the regulation shifting, they saw the climate data, they saw Tesla, and they said, electric vehicles are the destination.
And they were right. I mean, the world is moving that way.
Exactly. They were right about the what, but they were, you could argue, dead wrong about the when and the how. They jumped into the deep end of the pool mass production, huge battery plants, expensive models, before the average American consumer was actually ready to get in the water.
So they threw a party, bought all the expensive food, rented the venue, and the guests just didn't show up.
Well, a few guests showed up, but not nearly enough to pay for the party. And in manufacturing, being 5 years too early is, at the end of the day, financially the same as just being wrong.
Okay, so let's dig into that wrong part, because the scale of the financial damage is just, it's hard to wrap your head around. We're looking at the model division.
Right, that's their dedicated EV unit. The future of the company, in theory.
In theory. But in the fourth quarter of 2025, so just the last 3 months of last year, Model E lost $4.8 billion.
Let's just pause on that. That is not a bad quarter. That is an, oh, we missed our targets. That's a catastrophic hemorrhage. And remember, they only have 3 main EV models in that lineup.
Wait, so if they lost $4.8 billion in one quarter with just 3 models, that's like, what, $1.6 billion in losses per model in just 3 months?
Broadly speaking, yeah. The factory overhead, the R&D, the supply chain contracts, it all adds up. And if you zoom out to the full year of 2024, the loss was over $5 billion. You add it all up from 2022 to now, and there's your $16 billion crater.
And here's the part that really got me in the report. You'd think, okay, it's 2026, the early adopter phase is done, we're mainstream now. The losses should be getting smaller.
Right.
Like the curve should be bending up.
You would think that. Logic would say that. But Ford's own guidance for 2026 is the exact opposite. They are projecting another loss of $4 to $4.5 billion this year.
So the bleeding isn't stopping. It's not even really slowing down.
No, it's structural. The hole is so deep that Ford actually had to take a $19.5 billion special charge just to pivot its strategy.
Okay, special charge. We hear that on earnings calls and my eyes just glaze over. It sounds like an accountant jargon. But what does that actually mean? Because $19.5 billion, that's a huge number.
Think of a special charge or a write-down as an official admission of failure. It is Ford saying, you know all those factories we built, the equipment we bought, the plans we made.
Yeah.
They're worth $19 billion less than we told you they were.
Ouch.
It's writing off the past so you can clear the decks for the future. It's like realizing you built your house on a swamp. Before you can build a new house on dry land, you first have to admit the first one is worthless.
And while they're stuck in that swamp, they're burning cash they need for other things. Which brings us to the inevitable comparison. Because Ford doesn't exist in a vacuum. There's another company right down the road in Detroit.
The eternal rival, General Motors.
Can't talk about one without the other. And usually, if the EV market is soft for Ford, it should be soft for GM, right? Same economy, same consumers. But their strategies and their stock prices, look like they're from two different planets.
And this is where we get to the core lesson of this whole thing. This isn't really a story about cars. It's a story about capital allocation.
Okay, so let's break that down. Capital allocation sounds like something from an MBA textbook. What are we actually talking about?
We are talking about opportunity cost. It's the simplest rule in business. You can only spend $1 once. If Ford spends $1 to cover the loss on an unprofitable EV, they cannot spend that same dollar on anything else.
Like R&D.
Or marketing.
Or, and this is the key to the comparison, buying back their own stock.
Right, share buybacks. We hear about them all the time. GM announces another buyback. Why is that so important for the person listening right now? Isn't it just a trick to make the stock price go up?
I mean, yes, it is financial engineering, but it's engineering that works for the shareholder. Imagine a pizza.
Okay, I can always do a pizza analogy. Go for it.
The company's the pizza. The shares of stock are the slices. If you own one slice of an 8-slice pizza, you own 12.5% of the whole thing.
Got it.
Now, what if the company takes 2 of those slices away and just gets rid of them? They retire them?
A tragedy for pizza, but I'm following. Right. So now there are only 6 slices, but the pizza itself, the company, the revenue, the factories is the same size. So your one slice, which used to be 1/8 of the pie, is now 1/6. It just got bigger. It represents more of the company.
So by buying back its own shares, GM makes every remaining share more valuable without actually having to, sell more cars or invent something new.
Exactly. And this is the stark contrast. While Ford was shoveling billions into the EV furnace just to keep it from going out, GM was aggressively shrinking the pizza. In 2023, a $10 billion buyback. 2024, another $6 billion. 2025, another $6 billion.
$22 billion.
Yeah.
In 3 years.
Which is, ironically, almost the exact same amount that Ford either lost or wrote down on its EV gamble. It's a perfect mirror image.
Wow. That's painful when you put it like that.
It's the difference between being agile and being anchored down. I mean, you look at the charts in Miller's article, GM's share count is just plummeted, which is what you want to see. And their stock price reflects that. GM's trading around $83. Ford is struggling to stay above $13.
And to be fair, Ford does pay a dividend, right? It's not like shareholders get nothing.
They do. It's a classic dividend stock. But dividends are just cash. Buybacks compound value. Because Ford was so cash-strapped by these huge losses, they just couldn't play defense for their stock price the way GM could. They just had to watch that valuation gap get wider and wider.
So the lesson for you listening is, it's not enough to have a good product idea. You have to protect your balance sheet so you have options when things get rocky.
Cash is freedom. GM kept its freedom. It traded its freedom for a head start in EVs that didn't quite pan out.
Okay, so Ford's in a tough spot. They're bleeding money. They can't do buybacks. They're watching their rival lap them. The question I'm screaming at this report is, when does it stop? What's the fix?
Well, the analysis lays out the timeline, and yet I have to warn you, it requires a level of patience that the modern market doesn't really have.
Just give it to us straight. How long are we talking?
The bleeding doesn't stop in 2026. The new strategy, the actual products that are meant to fix all this, they don't even launch until 2027.
And launching a product isn't the same as making a profit on it.
Not even close. Launching is expensive. You've got marketing, distribution, factory ramp-ups. According to Ford's own CFO, Sherry House, and she was very clear on this, they do not expect the EV division to break even until 2029.
2029.
3 years from right now.
So we're sitting here in early 2026. And the message to an investor is basically, just hold on, keep holding on, a little longer. We'll see you in the 3 years.
That is the proposition on the table, yes.
So what makes them think 2029 will be any different? I mean, if they couldn't make money on the Mustang Mach-E or the F-150 Lightning, these are premium, expensive cars that people actually seem to like. How do they make money later?
Well, this is the really fascinating part of the pivot. They're not going to raise prices. They're going the other way. They realize the build it big and expensive strategy just failed. So the new strategy is all about a universal EV platform and a new midsize electric truck.
And what's the target price?
$30,000.
Wait, okay. A $30,000 electric truck? That sounds almost impossible. The battery pack alone eats up a huge chunk of that. How do you build a truck for that price and not lose even more money?
This is where the assembly tree concept comes in. The report mentions it, and it's a huge deal in manufacturing circles.
Assembly tree? Sounds like something you'd buy at a hardware store.
It does, doesn't it? But it's actually a radical rethinking of the assembly line. For 100 years, cars have been built on one long line, right? The car moves, and robots or people add parts.
The classic Henry Ford method.
Right. The assembly tree breaks that. Instead of one long line, you build huge sections of the car separately, these big sub-assemblies, and then you just snap them together at the very end. It means a smaller factory, fewer robots, and way less time spent on the main line.
So less time, less space, less complexity.
Mm,
It all adds up to a lower cost.
that's the bet. It's very similar to what Tesla has been trying with their unboxed process. Ford is betting everything that this new tech, plus a smaller, cheaper truck, will finally crack the code on EV profitability.
So the fix is basically, stop trying to sell $80,000 trucks to the few people who can afford them. Start selling $30,000 trucks to everybody else and build them so efficiently that you can actually make money.
It is literally the Model T strategy for the 21st century. Volume and efficiency over high prices.
But this brings us to the big so what question, right? We have to wait 3 years to even see if this new strategy works. Why should anyone listening to this care about Ford today? Why not just check back in 2029?
That is the billion-dollar question. And it brings us back to that capital allocation idea. But in reverse, think about the upside of just stopping the pain.
You mean just getting back to zero profitability?
Right now, Ford is dragging a $4 to $5 billion anchor behind its boat every single year. Imagine trying to swim with a weighted vest on.
It's exhausting.
If that anchor just disappears in 2029, suddenly the boat goes a lot faster without you having to do anything else.
That's $5 billion of cash flow that just appears on the balance sheet because it's no longer being lost.
Exactly. And what can you do with an extra $5 billion a year?
You can finally start buying back some of that pizza.
You can do massive buybacks and catch up to GM. You can raise the dividend. You can invest in high-margin software or autonomy. The options become endless.
So the investment idea is a classic turnaround play. You buy the stock now while it's beaten down at $13, betting that in 2029, the financial picture totally flips.
It's either a value trap or a massive opportunity, depending on how optimistic you are. The market has already priced GM for success. That's why it's at $83. It has priced Ford for skepticism.
For prove it to me.
The market is absolutely saying prove it. And often, the biggest wins in investing come when a company goes from being seen as terrible to just, okay, you don't even have to be great. You just have to stop the bleeding.
But, and there's always a but, 3 years is a long time.
It's an eternity in the tech world.
I mean, think about where we were 3 years ago. The AI landscape was completely different. The global economy was different. Interest rates were on the floor.
And that is the huge unspoken risk here. Ford is locking in a strategy today. This $30,000 truck, this specific battery, this manufacturing method, for a market that won't exist until 2029.
They're aiming at a moving target.
A very fast-moving target. What if, by 2028, a competitor from China enters the U.S. with a $20,000 truck? What if solid-state batteries have a breakthrough, and Ford's entire platform is built around the old, obsolete tech?
Then they're wrong.
Again.
And they might not have another $16 billion to burn on a third try.
It's like announcing you're going to release the world's best Blu-ray player in 2015. By the time it launches, everyone's already streaming.
That is the nightmare scenario. In the 20th century, a car's design cycle was 5-7 years. You could plan for that. In the age of the software-defined vehicle, 3 years is enough time for the entire game to change.
It really just highlights the tightrope these legacy companies are walking. They have to fund the present with gas engines, which are still very profitable.
Yeah.
Fund the future with debt and massive losses, and just pray their crystal ball for 2029 is accurate. It is maybe the hardest pivot in industrial history.
Okay, so let's just recap the journey today. We started with that painful number, $16 billion. The cost of being right about the future, but getting the timing wrong.
We saw how GM used that exact same time to create value for its shareholders, while Ford was basically forced to pay for its own very expensive education.
We looked at the promise on the horizon. A 2029 break-even, all riding on a new $30,000 truck and a new way of building it called the assembly tree.
A promise that requires, an immense amount of patience from investors.
Which leaves us with a final thought for you to chew on. We always hear that patience is a virtue in investing. Warren Buffett says the stock market is a device for transferring money from the impatient to the patient.
Right. It's a classic saying.
But there's a difference between patience and paralysis. If Ford is asking you to wait 3 years just to get back to the starting line of profitability, is that a real investment opportunity, or is it just dead money? In a world where tech reinvents itself every 18 months, can you really afford to wait 36 months just to see if a company can stop losing money?
Are you waiting for a train that's about to arrive, or are you just waiting at a station where the tracks don't even go anymore?
That is the $16 billion question. Thanks for diving deep with us today.
Stay curious.